Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss the financial shock many widows and widowers never see coming. Specifically, I'm going to discuss the financial realities that change after one spouse passes, the 7 negative financial impacts a surviving spouse will face, strategies to help mitigate these future issues, how a coordinated strategy is the most impactful, and lastly, as always, a few action items for you to consider. Over the course of my career, I have helped a number of widows and widowers transition through the loss of a loved one, some expected and some unexpected. And when the dust settles and time passes, oftentimes the surviving spouse is left with a completely different financial reality. One that may include higher taxes, clawbacks, increased investment withdrawals, and a looming tax bomb. So today, what I want to discuss are some potential negative consequences that can impact the surviving spouse, and then shift gears to discuss strategies couples can implement today to help mitigate the negative financial impact in the future. The first is the potential need to downsize or sell property. Now, this may be required to free up cash for living expenses or to simply simplify. This is nothing I suggest that you rush into, but for many it is top of mind after the first few months after the spouse's passing. If there are multiple properties involved, this may also mean there will be tax consequences on properties that were held individually and not jointly. The same tax consequences also apply to non-registered investment accounts that are held individually. The second potential negative consequence is the loss of the deceased spouse's CPP benefit. For most, this makes up a significant portion of their guaranteed predictable income, so the loss of this full benefit could impact the amounts they need to withdraw from their investment accounts. Now, granted, there is a survivor benefit that will help to replenish some of this income and could actually be very limited for others. The amount the surviving spouse may receive varies if they are over 65 or under 65, and also whether or not the surviving spouse is already collecting their CPP. The key takeaway here is that it will not be a dollar for dollar replacement. So while you will in fact receive a top-up, it will not be the same amount received by the deceased spouse. Furthermore, the amount that can be received is capped at the maximum pension amount. So if both spouses were receiving nearly full CPP benefits, the surviving spouse's survivor benefit could be negligible. Now, since 2019, there has been a CPP enhancement put in place. This is CPP you paid into during your working years over the yearly maximum pensionable earnings. The survivor benefit of this portion is not subject to the maximum, so there could be some additional benefit there if the deceased spouse made contributions to the CPP enhancement during their working years. But I'm starting to get into the weeds a bit here, so let's move on. The third financial consequence is the complete loss of the old age security benefit. OAS has no survivor benefit, so this monthly amount is gone for good. So again, potentially impacting the amount of money that needs to be drawn from investment accounts to make up for this lost income. The fourth financial consequence is the loss of pension income splitting, which this is a big deal, especially if you are over 65 with an RRSP or RRIF account. The ability to split income between spouses is one of the strongest tax planning strategies used to reduce household tax over time. The fifth financial consequence is the rollover of joint assets and registered accounts like RRSPs and RRIFs. Now, while these assets roll over tax deferred, all of that deferred tax liability now rests on the shoulders of the surviving spouse. Couple this with the loss of income splitting, and now the surviving spouse and his or her estate will be left to deal with the tax burden. The sixth could be the loss of the surviving spouse's OAS benefit. Now that all the joint investment accounts, RRIFs, and other accounts are in the surviving spouse's name, there's a strong likelihood that their income is now past the OAS clawback threshold, starting around $95,000. This is an effective 15% increase in tax and further loss of a guaranteed government benefit. The seventh is a continuation of the last, and that is the increase to the surviving spouse's overall marginal tax rate and the tax liability looming at the last spouse's passing. Now, there certainly are more financial consequences out there that you can probably think of. And if so, drop a comment in the podcast and let me know what you think I've missed. So let's go back through each of these potential negative consequences and provide some thoughts and suggestions on how each can be addressed during both of your lifetimes. The first potential negative consequence was the potential need to sell property when the spouse passes. This is an important planning and succession discussion to have not only as a couple, but also as a family, especially if there are vacation properties involved. Would one of these properties need to be sold to fund the surviving spouse's retirement income needs? Are there tax consequences? Which property would be the primary residence? Do the kids want the vacation property? If you did sell a joint property during your lifetimes, if the property was not your primary residence and capital gains were triggered, this capital gain could be income split between you both. To take this a step further, if you have a joint investment account with substantial capital gains attached, there may be a tax planning opportunity to trigger gains and split the taxable portion. Consideration of your entire financial outlook is critical here, but this could be a relevant planning strategy to free up tax-paid dollars and mitigate estate taxes in the future. The second and third consequences, a decreased income through the survivor benefit and an outright loss of the deceased's OAS benefit, are fairly related from a strategy standpoint, so I'll put these together. The core consideration you need to make as a couple is when you should start these benefits and how that decision impacts the rest of your finances. Some may consider delaying CPP to help draw down their taxable accounts and maybe choose to start OAS at 65 to ensure they receive some of the benefit because there is no survivor OAS pension. If either of you have health concerns or a family history of shortened longevity, you may want to factor these variables into your start date as well. When one spouse dies, many of the fixed expenses do not change, while some of the lifestyle spending obviously will. So even if there is a reduction in monthly spending, it will likely not be reduced by 50%. So the next step would be to then stress test this loss of income or the loss of the other guaranteed incomes. How would this impact your monthly spending? And determine the gap that would need to be drawn from your retirement accounts. For most listening, the gap likely won't impact your spouse's ability to stay retired. There may be some additional tax consequences during the drawdown stage, but again, likely not having a significant impact on the ability to stay retired. The fourth, fifth, and sixth consequences are also correlated, and those are the loss of pension income splitting and OAS clawback of the surviving spouse and a higher marginal tax rate to now the surviving spouse and the estate. So from a tax standpoint, this is where we need to discuss some strategy. Here, the overarching strategy is to create a deregistration plan. This is a strategy to tax efficiently draw down your retirement accounts to increase flexibility, maximize government benefits, and mitigate your and your estate's total tax bill. Pension income splitting allows us to potentially draw down more funds out of a highly taxable account while splitting said income with a lower income spouse. Drawing down on highly taxable accounts helps to alleviate the future tax burden and minimum withdrawals that could see taxable income increase after the first spouse's passing. This then lends itself to being able to better control taxable withdrawals to the surviving spouse later in life, reducing or eliminating the impact of OAS clawback in the future. And at the end of it all, most of what's left will be taxable to the estate. And if left unchecked for 10, 20, or 30 years, the tax bomb could be well into six figures. Now, as you've probably put this all together by now, tax planning is key and it's complicated. This is not a one and done strategy. It is a year-over-year coordination of your entire retirement plan that factors in all of these moving parts, not only to make you and your spouse's life better today, but to also mitigate the tax burden to the surviving spouse in the future. Tax planning with a retirement specialist is forward-looking. We continue to evaluate your income sources, account balances, government benefits, spending needs, and future tax liabilities to identify opportunities before they become problems. Because the reality is that when the first spouse passes away, there is little planning left to do. Most of the opportunities to reduce taxes, preserve benefits, and create flexibility needed to be implemented years earlier. While none of us like to think about losing a spouse, planning for that possibility is one of the greatest financial gifts you can give one another. It can help to ensure that the surviving spouse has more income flexibility, fewer tax surprises, and greater peace of mind during an already difficult time. Okay, so that'll do it for today. Only 2 action items for you. First off, if you have a spouse and you are between the ages of 58 and 68, I strongly encourage you to create a coordinated plan today. If you work with an advisor and are looking for a second opinion, or a DIY investor ready to work with a fee-based advisor, I strongly suggest you check out our fundamental retirement plan. Lastly, if you've been enjoying the show, I encourage you to share it with a friend and leave us a 5-star review in your favorite podcast app so our message can help more and more Canadians. All right, that'll do it for today's episode. Be sure that you sign up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.